Welcome everyone to this special session we have held today. The idea of this session is that when Bombay Chartered Accountants Society and the International Tax Committee, we've realized that developments which are happening currently in the US, some of these developments, as we all know, day to day there are news happening which are impacting the world over, and we can all attribute it to one person. But thankfully, the requirement for us to study is narrowed down to this one particular bill, which has its impact on a cross-border tax issues for all of us here. So anybody who is dealing with US clients or dealing or having investments in US businesses or dealing with US businesses, whether it be through entities or individuals, we would have these kind of issues when we come to the one big beautiful bill. As is very patent now, the name of the bill itself is, unique. We have never had a bill which starts with one big beautiful bill. Uh, but this is, I understand, typical of US laws that they try to cover lot many things in one bill. The bill itself, as its name states, is such a large bill that we would need help from experts to analyze and get into understanding what these issues are, what we need to understand from it, where do we have to be careful about when dealing with US clients, or as we discussed, for those who have connections with USA. This session is planned in that sense. We have had deliberations. The faculty here have already had a couple of conversations where they have also helped us out in drafting the queries which are required. There is only one change from the announcement, but very important change. This session was to be moderated by CA Hardik Mehta, but due to some family emergency, he has not been able to make it. We thank him for all the support he has shown till now. In fact, a lot of this is possible today because of his, untiring efforts. Unfortunately, he cannot be with us today, but Paresh Bhai Shah, CA Paresh Bhai Shah has stepped in and taken the role for moderation today. We are grateful to him and indebted to him for taking up at this last minute. But we believe that we will be, all of us will have the great discussion or very insightful discussion under his moderation. And coming to the faculty, we also have Prathamesh, Hegishte, and CPA Vinay Navani joining us all the way from US directly. The all three of them put together are planning to give a lot of inputs and a lot of insights to us in the next 2 hours. Before we start the formal proceedings, I would request if CA Mahesh Naik can introduce the faculty so that we can start.
Thank you, Ritik Bhai, and welcome to all participants here. Formally introducing the speakers for today. So the first panelist we have CPA Vinay Navani. Vinay Navani, he's a shareholder at Wilkin Guten Clan. He joined the firm in 1998. His client roster includes emerging and established businesses in the life science, software, manufacturing industries, and other closely held businesses and business owners. He chairs the firm's India practice, and has a deep knowledge of the nuances of the income tax impact for businesses and individuals conducting business in the US and India. Prior to joining the firm, he served as a technical manager for the American Institute of Certified Public Accountants. In this capacity, he has provided tax research services and professional expertise to other CPAs. He was also previously a tax manager at an international CPA firm. He is also a member of various societies, New Jersey Society of CPA, American Institute of CPA. He's been a past president of the Middlesex Somerset chapter of the NJCPA, and he's a regular speaker on various tax and financial planning topics to other CPAs, business owners, and the media. And we have also, benefited that in earlier also a few years back, we had him address our participants on US tax implications, and we thank Vinay for once again joining and to address our participants on this very important topic. The next speaker we have CA Prathamesh Hegishte. Prathamesh is a director within the US tax advisory service practice at KNAV. He provides federal tax advisory services ranging from mergers and acquisitions, corporate restructuring, and international tax, with a specialization in ESOP strategy and implementation. He has advised businesses on various federal tax aspects, aided in developing tax efficient and compliant business structures, inbound and outbound investments from a tax perspective, cross-border taxation, and tax due diligence for proposed acquisitions. This enables him to provide holistic solutions to businesses. He has been involved in preparation, review, and filing of corporate federal income tax returns in the US, and also advises several multinationals and helps them in preparation and review of withholding tax returns and other information forms. Thank you, Prathamesh, for joining us today for this very important session. A moderator for today, as Ritvik mentioned, who joined in at the last minute, and thank you, Paresh bhai. Uh, so CA Paresh Shah, he is, I think all of us know him very well. But for formally introducing him, he qualified as a chartered accountant in the year 1984. He specializes in FEMA and tax with a special focus on cross-border transactions and taxation, inbound and outbound businesses, tax and regulatory aspects, foreign collaboration, and joint ventures, legal as well as tax aspects. He successfully launched a unique international tax journal of the Chamber of Tax Consultants in Mumbai and has been designated as the first editor of this prestigious journal since June 2017 for the first time in India. He has co authored various publications, including FEMA for Individual or Day to Day Practice, published by CTC in December 2023, a handbook on FEMA taxation, frequently asked questions, published by the AIFTP in September 2018, a book on custom baggage rules published by BCAS on 23rd March 2011, a book on FEMA and taxation published by AIFTP in 2009, and various other publications. In fact, he has presented various papers also at various conferences at professional organizations, including the AIFTP, WIRC, CTC, and BCAS. He's a regular speaker at various events and has also been chairman of various committees, such as the chairman of membership and PR committee of the CTC, chairman of the International Tax Committee of the CTC, as well as vice chairman of the Journal Committee of CTC, and has also been a member of the International Tax and Finance Study Group of the BCS. So, on that note, we once again thank Paresh Bhai Shah for agreeing to moderate this session and welcome him. And I'm sure all of us are looking forward to a fantastic session. Over to you, Paresh bhai.
Thank you, Mahesh, for the kind words. And thank you, society, for giving me this opportunity to moderate this session. I am placing myself at the last minute, but I'll try my best to endeavor that large gathering has spent their time worthwhile. With that initial note, let me just talk to you briefly about what is the agenda for the day. Rest of the day, of course, 5 to 7. We are going to talk about one big, beautiful bill act. Whether it is a beautiful or it is a big, etc., we will come to know at the end of the session. However, would like to make some comments as to the practical utility relevant with this one big, beautiful bill act. The Indian residents going or migrating to US, setting up their own business in USA, having large business set up in India or any other country. There are several issues which are arising because of this such cross-border business presence for a shareholder or for an owners or for partners. So when you are US person, you are US citizen, the law migrates with you, the law migrates with wherever business you are setting up. And not only the domestic law of taxation where you are operating in foreign country, but the law of US operates in a manner where it travels to the country by country where you have a presence. And it would like to have its pound of share if you are paying lower taxes than what you are otherwise would have paid in USA. And this particular aspect you will find in several provisions. And therefore, the provisions of scope of taxation. In your own country, you may not have certain item of income as a scope of income, whereas US will say this kind of a foreign income earned by either a resident of USA or a company incorporated by the shareholders of USA will attract tax in USA. Like you are well versed of the provisions of the controlled foreign corporations, which being extended in the form of guilty and the foreign tangible income. So similarly, the competition mechanism, after the scope of the income being defined, we go to the computational mechanism. So the competition mechanism, what you understand in India, will be quite different as compared to the US. Like for example, you will have a different type of expenditure allowance in case of immovable property, in case of expenditure incurred in the domestic territory of USA versus the expenditure being incurred outside the USA. In terms of some of the expenditure, some of the nature of expenditure, you will know that the if income expenditure are incurred in USA, they are allowable. Whereas if that those similar expenses are incurred outside of USA, then they have to be capitalized and amortized over the fixed period which is specified in the law. So, then there are several the adversarial taxes, like if some of the countries have a taxes which US thinks that they are not the fair policy of taxation, then US shareholder having business in those countries or those shareholders having business in USA will be penalized in some or other forms by the US. And we all know what has happened to the equalization levy in India and etc., which US says that's not the law which is fair. So therefore, those provisions are also found in the US tax law, and and there are several such aspects of the law in USA which we must know because they are essential for considering what is the scope of income as well as how the income will be computed and how it is different than what we understand in India and as compared to what is there in USA. So with this brief background, I thought that this is very relevant, and this we are not covering the US taxation per se. We are not covering the provisions of the law as we want to have normal course in which we learn income tax of USA, which will be, I've heard, taken up separately by the Committee on International Taxation of BCA Society. However, here we are concerned with this big, beautiful bill act, which has impacted a lot in the recent time. So, on these aspect, we have scope, which is very focused on this one big, beautiful bill act, which is, of course, named as Bill Beautiful Act. Otherwise, it is also known as Jobs Cut and Taxes Act. So with that brief remark, I would like to consider several questions to the panelists on the basis of the provisions of this beautiful bill, so that we all understand this bill properly in the right perspective, and we can do the homework as to what we understand in India and the provisions are and how they are different in the United States. There are questions which are affecting the individuals as well as to the business entities. So, uh, so there are questions on individuals, there are questions on the business entities. So, I'm told, and we have bifurcated the division in a manner that Vinay will take up the questions on individuals, whereas Prathamesh would deal with the issues which are relevant to the business income in the United States. So, first question, which I would like to consider, is the recent phenomenon in India. We are well versed with what has happened to the applicability of the remittance from United States. You know, we have in India a provisions on TCS, where under the liberalized remittance scheme, when we remit any money, whether it is an income of a foreign individuals or a remi or the person to whom the remittance has been made, the TDS tax has been collected from the payer of the payment. Similarly, we find an introduction of remittance tax in USA through this big beautiful bill. So, can I request Vinay to take up this particular phenomenon as to what is this remittance tax, how it is affecting the individuals, how it will impact the taxation, whether they will get credit or not, on what instrument this tax has been collected, whether all the persons who are remitter will get the tax credit in their return or not. Can you please highlight this particular aspect to all of us so that we start with the recent phenomenon which we are all concerned? Yes, Vinay?
Sure. Yes. Well, hello, everyone. So let's talk about this. So this obviously got a lot of attention outside the US. It did not get much attention inside the US. And when, in the US, we have the tax legislation starts with the House of Representatives. They agree upon a bill. Then it goes to the Senate. They make changes. And then usually there's compromises. Both houses approve, and then it gets signed into law. So when the House bill came out, there was a pretty punitive remittance tax of 5% on any outbound transfers. It didn't really define remittances very well. And effectively, that remittance tax was based on, was assessed to non-US citizens. So it created a lot of controversy. What we got in the final Senate bill, which turned out to be the final law, was a much, much smaller issue. And I don't think that the remittance tax is a major issue anymore. It's a 1% tax, and it's a 1% tax on remittances that effectively don't go through the standard banking financial institutions. So as long as you're wiring money from a US bank account to a family member's HDFC account or an SBI account, there is no remittance tax. It's only if you're using one of these non-banking institutions and you're not a US citizen is there a 1% tax. And that excise tax would be collected by the transferor, the non-bank institution, and it's 1%. So I think the number of scenarios we're going to see this tax apply, excuse me, is very small. And so right now I think it's a very minor topic at this point.
So it is, I think, taking place effective from 1st January 2026, right?
I think so. Frankly, once it got changed to be 1% and to exclude financial institutions, we're not even focused on it. But I do think it is a January 1st, 26.
Do you think how it is related with the immigration policy of the country, as we see in the provisions of the law, that this is being introduced to avoid illegal immigrations and things like that? Is it something which is very relevant, as you think?
Well, look, I know taxes, and I take the laws I'm given and I do my best to interpret them and plan around them. So I don't want to get into a discussion about what the motivation is, but clearly it's a tax on outbound transfers by non-citizens. So, you can read into that what you wish. But again, at the end of the day, all the teeth of that provision were really taken away by making sure that funds that went through the banking channels were not subject to this tax.
Okay, thank you, Vinay, on this question on the remittance.
Sure.
I would also like to take second question to you, which is on passive income, which a US investor or a US person earns from the foreign countries, particularly from India. And I also hear that this passive income law has been extended to the other business income also in the form of regulations called GILTI to include those income into the US fold, including the FDII, which is called foreign investment income, which is low taxed income. So would you like to consider as to how the US person who are non-resident of India and staying in India in the United States will have to pay their taxes in United States on the income, passive income, earned by them in India, either in the form of guilty provisions or FDI provisions? And also, would like to ask what is the rate of taxation and how it is computed?
Okay, so so let's kind of separate the two sides. Let's talk about passive income, like what I'm going to think of as interest, dividends, capital gains, and then guilty, which is not guilty anymore, but same concept that either I or Prathamesh can speak to. So the US, if you're a US tax resident, it takes a worldwide approach. The US doesn't make a distinction whether the income is earned from a local bank or an Indian bank. The US person has to pay tax on their worldwide income. So for interest income, they would report all their interest income on a calendar year basis. Dividend income, same thing, report all dividend income. Capital gains, you report all capital gains income that happened during the calendar year using US tax rules. We then look to see, is there a foreign tax credit available? Right, so interest and dividends, relatively straightforward. There's a computation. My understanding is the computation in the US is similar to the computation in India. And the effective idea is that the US will never give you a credit more than the US would have taxed you. So if you're paying a higher rate of tax in India on the interest or dividends and a lower rate in the US on those same interest or dividends, you'll basically get the lower tax. So
Okay.
that's.
Thank you. We can pause here and switch to Prathamesh, because that's a large portion of guilty and etc. is part of business income.
Yes.
And also, there is a new terminology in the Tax Cuts and Jobs Act, whether it is the same item which is renamed, different nomenclature, and how it applies to the business income of the US persons outside US in India or in another country. Yes, Prathamesh?
Sure. So let's take a step back. So particularly what happened in the Tax Cuts and Jobs Act that was introduced back in 2017 in the first Trump administration era. What used to happen is that previously to the Tax Cuts and Jobs Act, the US used to have a taxation system wherein only the dividend income when it is received from a foreign subsidies that used to get taxed in the US. Okay, apart from the passive income. However, in the Tax Cuts and Jobs Act, what the Trump administration did is that it introduced a participation exemption, thereby which now the dividend income that comes in from the foreign subsidiaries to the US companies, okay, that becomes exempt, or a dividend received deduction is received correspondingly under Section 245A. Uh, as part of this, correspondingly, on one hand, it kind of exempted the dividend income. On the other hand, it introduced this concept of a guilty, wherein the income of the foreign subsidiaries are taxed in the US as and when those are earned itself, irrespective whether those amounts are distributed back to the US or not. The way the taxation of guilty works is that, okay, it used to consider whatever income is earned by the foreign subsidiaries. It used to allocate 10% of the tangible base asset income out of the total income as a net tangible income. Okay, and only the remaining portion, that is the total income of the foreign subsidiary less the 10% of tangible income, which they used to call as a Cuba income. Okay, only the remaining portion was taxed as a guilty income in the US. That guilty income used to get taxed at the rate of a 21%, against which again a 50% deduction was received under Section 250 deduction. Now this was purely received by the corporations itself. Okay, thereby which the effective tax rate used to come down to 10.5%. Correspondingly, we also receive the foreign tax credit. So whatever taxes have been paid in India, 80% of those taxes were allowed to be credited in the US against these taxes. So if my effective tax rate in a foreign jurisdiction was, let's say, more than 13.125%, I used to not end up paying any taxes in the US on this guilty income. Now, as part of this One Big Beautiful Act, which was just introduced recently in July 2025, it made two changes with respect to the guilty provisions, or I'll say three changes. First, it renamed it as a net CFC tested income. So the guilt is now renamed as a net CFC tested income. What changed it there is that it removed this concept of this QBI, the 10% tangible asset base which I was referring to. So now the entire income is subject to tax in the US. We are not allowed to reduce that tangible base. Okay. Second change that it made is that the 50% 250 deduction, which I refer to, has been now reduced to 40%. So thereby, which my effective tax rate has gone up from 10.5%. It has, I think, gone up to 12% or so. Okay, particularly. And also on the foreign tax credit, previously I used to get 80% credit on whatever taxes I've paid in the foreign jurisdiction. Now that it has been changed to 90%. So the US corporates can get 90% of a foreign tax credit what they've paid in the foreign jurisdiction. So broadly, these are the three changes that have been made and under the One Big Beautiful Act as compared to the previous version of the Tax Cuts and Jobs Act.
So can we say, Prathamesh, that if the foreign jurisdiction is paying taxes which are not tax haven or the protected regime, then there will have no tax liability or very negligible tax liability in the US?
Right, right. So see, so let's say like country like India, which has a corporate statutory tax rate of 25%. Now, okay, so in under guilty, there used to be also another concept of the high tax exception. So what that concept says is that if your income, okay, has been subject to tax in the foreign jurisdiction at an effective tax rate of more than 18.9%, which is effectively 90% of the US corporate tax rate of 20 or 21%. Okay, so if your income has been subject to tax in the foreign jurisdiction for more than 18.9%, then essentially you're not required to include guilty itself in the US taxable income. So it used to provide this high tax exception, and it even currently provides this high tax exception. But the countries where the tax rate is lower, only for them this guilty inclusion was needed. Now, one problem which many, the corporates face even today is that what happens is that currently, let's assume a structure. It's a US company with an Indian subsidiary. Okay. Now, Indian subsidiary, let's say historically have been making losses, but in one of the year, it kind of started generating profits. Now, for the India taxable income purposes, what will happen is that the previous year losses will get offsetted first. So eventually, we will not be paying any taxes in that particular year. But in US, we need to still include the entire income as a guilty income. And we can't claim the high tax exception as well because in that year, the effective tax rate has not been 18.9%. So that years becomes challenging from a US perspective. We end up considering entire income in the US and end up paying taxes on it on a 21%, at a 10.5%. Even in US, if we have losses, our losses get utilized unnecessarily. So that's still a draw, a backlog that needs to be solved.
Also, I've heard that these provisions are also applicable to Indian LLPs and partnership firms. Is it true?
Right. So what happens is that see the Indian LLPs or an Indian partnerships again it's a distinction. Uh, US has the way the tax classification of the entity the US determines. Okay, it kind of buckets into two categories. One is a corporation, other is a partnership. Okay, a pure partnership US also treats similar to a partnership. Okay, what happens is that in such cases the income earned by the foreign partnerships are immediately taxed in the US. Now this is outside guilty even prior to TCJ when guilty was not there, a partnership income was always considered as a flow through income, and immediately it used to get taxed in the US. However, LLP is kind of as a different concept from a US perspective because of its limited liability nature. US treats LLP similar to a corporation unless in the US we have made a election to treat it as a partnership itself for a US tax purposes and treating it as a corporation, then the guilty implications, arises similar the way it applies to any Indian corporation.
So can we say that therefore, if you're holding partnership firm and then you are migrating to the United States for good, and so it's better to have LLP or a company structure rather than a partnership firm structure?
Um, See, it depends. Eventually, we need to overall evaluate what are the tax outcomes of the regular taxation of the profits, the dividend repatriation, and thereafter even the further exit. All three things needs to be considered. Thereafter, which only a decision can be made. What's a better.
Thank you, Prathamesh, for comprehensive answer. Now we have certain questions from the participants.
Sure.
So the question is: Is the remittance tax withheld by non-banking institution refundable? And if so, how to get the refund? I think this is a question to Naveen.
Yeah, so I think it's refundable if the sender is a US citizen. I'm not 100% sure on that. So if you want to email me afterwards, I'm happy to look into that in more detail
So
for you.
So can we say that the whoever is the remitter, the tax credit will depend on the category of the persons, whether they are the tax resident or a social security holder or a citizen. Depending on the categories, they will get the tax credit, or they may not get the tax credit. That's what you want to say?
It's based on their category.
Okay,
Correct.
thank you. So that's a question to Mr. M. Arunachalam, and that is the answer from Naveen. The next question is, what is the rate at which FTC can be claimed in India on US dividend and US interest? So basically, this is a India-US tax treaty questions, that what rate of tax credit will be available in India to the corporates if the tax is deducted by the US while paying the dividend and interest to the Indian shareholder or a lender. That's a question from the business perspective, probably. So, Prathamesh, will you take up this question?
Sure. So again, when a U.S. company is paying dividend to India, as per the U.S. domestic laws, withholding rate of 30% is applicable. But as per the India-U.S. treaty, that rate can be reduced further to I think 15% or so. And thereafter, which then it's an Indian domestic law issue, wherein whether we get a credit for that the taxes that are withheld in the U.S. or not. In most cases, I think the credit is generally available, but more of a India tax issue. Similarly, for the interest as well, the general withholding tax rate in US for any foreign payments is 30%. But as per the tax treaty, even that I think the rate is reduced to 15%, or even in some cases it can get reduced to 10% as well as per the tax treaty. Thereafter, which again claiming of credit becomes more of an Indian tax issue, which ideally a credit should be available in India for the taxes withheld in US.
Okay. Thank you. This was a question from Gita Thakur, and that is being answered by the Prathamesh. I think the comprehensive answered, so we should not have any problem. Now, next question is from Jankhana Javeri. She says that classification change using Form 8832 and treating Indian Private Limited as pass-through partnership would get guilty would still be applicable. A question to Prathamesh.
Right. So see, yeah. So if we file the form 8832 and change the tax classification, then for all US tax purposes, the foreign entity, the Indian private entity, will be considered as a partnership and not as a corporation for US tax purposes. Guilty is applicable only on the foreign corporation. But as I explained previously, even in case when a US corporation is investing in a foreign partnership, irrespective of guilty provisions, any income earned by that foreign partnership by default needs to be included in the US taxable income. And correspondingly, we can claim foreign tax credit benefit as well. So it
I,
eventually need to do a scenario analysis which is better for us.
Another question from Zankana is, would not SC tax would be an issue in partnership structure?
So, sorry, I'm not clear with the what SC tax means.
Self-employment tax. So I'll answer that question.
Solven.
Yes, it generally would be a consideration. It's not automatic that self-employment tax would be applicable, but it often is in a partnership structure. So yes, it is a consideration.
I think it is treated as self-employed. The partner is considered as self-employed in India by virtue of being partner, and then of course taxes is one aspect, but whether self-employment tax is also payable by such a partner.
Right.
That's
And in the US, we have a similar concept, and in most cases, self-employment is an issue, but not always, depending on the type of income.
Thank you. So that were the questions from the participants. We answered all of them, and we can go to a few more questions before we have some more questions. Yeah, this is a question to Vinay. Vinay, as we understand this big beautiful bill act, let me go to a little bit of basics. How does these tax reforms or personal income tax rates impact Indian individuals living in US?
Indian individuals living in the US. Okay. So in 2017, when the Tax Cuts and Jobs Act came out, the individual rates lowered. The top rate went from 39.6 to 37%, and all the different tax slabs came down. Under the Tax Cuts and Jobs Act, there was a limited term, and those rates expired at the end of 2025, and they were going to revert back to the earlier rates. So one of the main features of the I call it OB3, is that those rates that were enacted in 2017 stay in place. So it's really depending on how you look at it, it's either a tax cut, because if the law wasn't changed, taxes would go up, or it's tax maintenance because the rates are staying the same. You're paying the same tax rates as last year.
And I've also heard that there are limitations on credit being available in the federal tax returns, even if though tax has been deducted. Is that something this particular big, beautiful act provides for?
So when you say credits, are you talking about what because there's
There are
tax credits? Yeah, go ahead.
sorry, just to clarify, not to intervene in your answer, but just to
Yeah, of
clarify that
course.
there are tax deducted from the payment of income, right? Those resident individuals in United States, and those taxes are not in some situations fully available while filing the federal tax returns. Is that something true?
So perhaps I'm misunderstanding, because the main, if I'm a regular employee, I get paid, and one of the withholdings will be federal income tax. That federal income tax shows up as a full credit on my US tax return. So I separately compute my tax liability, and then I offset that against that with my federal income tax withheld. If I've had too much withheld, I get a refund. If I have not had enough withheld, I owe money. Now, there are other types of credits, specifically the foreign tax credit, that there are limitations on what I may not get a full, if I have $1 of Indian taxes paid, I may not get a full dollar of credit against my US tax, because that gets into the computations of the foreign tax credit. There has been some minor technical tweaks to those rules, but nothing significant.
Okay, thank you so much. Yeah. So there will be full tax credit if the taxes are deducted and tax payable in the federal tax returns are higher than the tax deducted. And if the taxes are deducted in foreign countries on source of income, and the taxes payable in the United States are lower than the tax deducted, then you may not get the full tax credit. That's what you want to say?
Yes, basically.
Coming to the next question, Prathamesh, over to you is, this act talks about R&D expenditure, that if it is paid in the United States, then you have the favorable tax treatment.
Yes.
Whether it is paid outside of the United States, there are some shortcoming in claiming the full expenditure. Would you like to explain what is this law all about on R&D expenditure if incurred in the United States, and if they are incurred outside the United States, either by a captive R&D units or to the third party?
Right, right. Sure. So, okay. So again, this was a provision part of the Tax Cuts and Jobs Act. Beginning from the year 2022, there was a drastic change in how the R&D expenses were deducted for the US tax purposes. Previously, entire R&D expenses were deducted in the first year itself where those were incurred, irrespective whether those were incurred within the US or those were incurred outside the US. All the R&D expenses were 100% deduction for the same was allowed in the first year itself. However, beginning from the year 2022, a drastic change happened, wherein the R&D expenses that have been incurred within the US were required to be capitalized and amortized over the period of 5 years, whereas the R&D expenses which were incurred outside of the US were required to be capitalized and amortized over the period of 15 years. So there was always a big backlash on this provision. Particularly on one hand, US were always used to promote itself as an R&D hub and tries to promote innovations, and so US also has this concept of R&D tax credits as well, which is a dollar to dollar credit against the US federal tax liability. Now with this backlash, there was always a big demand to repeal this provision, and even previously also there were efforts to repeal these provisions, however it did not succeed. However, as part of this one big beautiful act, this changes came into effect, wherein the R&D expenses which have been incurred within the US are now allowed to be 100% expensed off in the first year itself. So it's a one of a beautiful provision, okay, for the US companies. However, the provision for the foreign research, okay, the R&D expenses which have been incurred outside the US is still required to be capitalized and amortized over the period of 15 years. Now, if you have to think from a US logic perspective, because they want to promote R&D activities within the US, and that's why if a company is taking that R&D activities outside of the US, it is mandating it to capitalize it and amortize over a longer period for a tax purposes.
Whether it will have any difference, captive or a third party?
No, for both. So even let's say I have my related party itself based in India, which is doing the R&D work on the behalf of a US corporation, then also it will be subject to 15% amortization rule because the work is happening from outside of the US.
Thank you, Prathamesh. Uh, Moving to the questions from participants. This is Manit Singh asking questions on is there any change in business interest limitations and business loss limitations in the Beautiful Act?
Sure. So
Prathamesh.
yes, I'll take two things separately. First is on the business loss. So particularly, there's no change in with respect to the business loss limitation. So from the year 2018 onwards, the business losses can be carried forward indefinitely. On the other hand, business losses can be used only to the extent of the 80% of the taxable income for that particular year. This provision remains intact as it is. Uh, Now coming to the interest provision, yes, definitely there is a major shift over there. Uh, Currently, the business interest expense is allowed to be deducted only to the extent of 30% of EBIT, earnings before interest and taxes. However, a change has been made now as part of this One Big Beautiful Bill Act, wherein now the interest expense will allowed to be deducted with 30% of EBITDA, earnings before interest, tax, depreciation, and amortization. Now, what it does is that it increases the base of the interest limitation computation from EBIT to EBITDA, thereby which allowing a higher amount of interest expense to be deducted for the US tax purposes. So this is also kind of a beautiful provision that has been introduced and definitely a welcoming provision for the US corporates, especially which has a big debt sitting in its books of accounts.
Um, Earning before interest, tax, depreciation, amortization will be reduced, right? Than EBIT.
No, so because what 30% of EBITDA. So let's take an example.
Yeah.
My let's say my EBIT is let's say $100. Okay. Or I'll start from a PBT perspective. Okay. Let's say my PBT is $200. Now previously what used to happen is that from my PBT I also need to reduce my depreciation and amortization. Okay. Let's say my depreciation and amortization was let's hypothetically $50. So my EBIT base, remaining base, assuming let's say assuming the entire portion is EBIT. Okay. My EBIT base was particularly $150. Okay. Now on this $150, I used to get deduction of 30% only, which will be roughly $45 of interest expense that I can deduct in the current year was only $45. Now because of this EBITDA provision, what I need to do is that to my EBIT of $150, I again add back my depreciation and amortization of another $50. So my base itself goes up to $200. So now on this, instead of 45, I can deduct $60 of interest expense in the current year.
Okay, so the
And
base
one,
is increased.
correct, correct. And one provision that has remained changed is that any interest expense that gets disallowed due to this 30% limit, it can be carried forward in the future years indefinitely and can be used when the base is higher, which allows for the interest deduction.
Is it in line with the BAP section plan, or there is a different definition of the EBIT and EBITDA in the BAP section plan?
No, so the EBIT or EBITDA is it's purely the US has simply called it as a tax EBIT or a tax EBITDA. So you have to take into consideration all your M1, the book to tax disallowances, and so on, and even the depreciation they refer to as per the tax books of accounts.
So is it same as we understand? 30% of EBITDA is deducted. With, uh, but is it applicable to all interest or only related party interest?
It's a all interest.
All interest.
All interest.
Yes.
Okay, let's see whether we have any more questions, please.
Yeah, there's a number of more questions.
Yeah, there are. The question from whether transpricing documentation is applicable to every company in USA, like in India, and rules are also there for benchmarking. That's a question from the business perspective. So let's, Prathamesh, can you take up this?
Yes, yes.
Whether
So
whether the
there is,
transparency is applicable to every company in USA, or if there are threshold or not, and whether documentations are also required as we require in India.
right. Right. There's often a lot of misconception that transfer pricing is not applicable in the USA. That is completely wrong. Transfer pricing is without any threshold limits. Transfer pricing is applicable on all international transactions that happen from the US or from within the US. Uh, the only difference is that in India, the way we have a particular filing, wherein every year we need to file a report with the government to this 3CEB. US does not mandate or is not required to file any report with the US authority. However, the law clearly mentions that we need to maintain a backup documentation that needs to be provided to the IRS in case of the IRS audit happens. So for all the transactions, a strong transfer pricing documentation needs to be maintained from a US tax perspective as well.
Okay. Okay. So it is basically required to be maintained by the taxpayer, but not required to be filed unless it is requested by the IRS on audits.
Correct, correct.
So that brings us to a question on this adverse tax law in the foreign countries for Vinay. What is this
Okay.
provision about that the US can levy higher taxes the from the shareholders of the US corporations who are located outside of the US when the provisions of the law of those countries are not in line with the US law or they were adverse to the US law.
So I think what you're
Particularly,
talking about,
reference has been made, sorry, the particularly reference has been made to impact of Section 899 mechanism, revenge tax, and
yes.
what is the position now after the big, beautiful act?
So in the initial House bill, there was this Section 899. And what it was really designed to go after was to penalize countries that have basically what we call a digital services tax, because the US policy is very much opposed to that. And basically, the US would identify which countries had these, what they called unfair taxes, and impose a higher tax rate on taxes with withholding taxes on transactions with those companies. By the time it got to the Senate, that provision was repealed. So as we stand here today in the final law, that concept does not exist. It gained a lot of attention, but it was not included in the final law.
All right. So the next question is from participant. Talking about it's the question is dealing with salt, state and local taxes called salt cap increases in global tax reduction. So when is salt reduction applicable? State and local taxes cap. How can individual benefit from the limit of salt cap reduction raised under the beautiful act?
So in the US, obviously, we have taxes at the federal level, and then the 50 states, most of them, not all of them, most of them have an income tax. So if I make $100 of income, I'm paying a certain portion to the federal government, and I'm paying a certain portion to my state. prior to 2017, any amount that I paid to my state was allowed as a deduction on my federal return. In 2017, that limit was severely cut, where there was a limitation imposed for the first time of $10,000, which was very low. And that not only applied to income taxes that I would pay to my state, but it also applied to property taxes that I would pay because those were deductible also. So this was a very controversial issue. Many legislators from states that have a high rate of tax, New York, New Jersey, California, their residents were severely impacted by this because they pay a high state tax. So one of the compromises was that 10,000 limit was raised to $40,000 under OB3. But once your income reaches 500,000, that 40,000 phases down, and when you hit, I think, 600,000, you basically get to the $10,000 limit again. So for people making less than 500,000, it's generally a tax benefit that didn't exist before OB3.
Okay, so can I just summarize that if your
Sure.
income is between $1 and $500,000, then you get tax credit up to 40,000 in the new act. Earlier it was 10,000 only, and above 500,000 again it gets reduced to $10,000. That's what I understand.
Correct. I would just clarify, it's a deduction, not a credit.
Okay.
It's a reduction in income.
Okay, so
not
that
a-
reduces your income, but not the taxes. Yeah, okay, that's a good clarifications. And you mentioned that this includes the taxes on properties.
Correct.
The taxes paid in the state on properties also are deductible while
Correct.
computing the federal income tax. And then these are all
subject to that 10,000 or $40,000 limit.
Thank you so much. Yeah. That brings us to another interesting question as to Naveen, what are the provisions about the gift tax in United States? What is the estate duty tax provisions in the United States? What are the limits? What are the annual limits? What are the spouse limit? What are the one-time, lifetime limits on estate, etc.? Can you just clarify what is it all about?
Yes, yes. And before I get into that, I want to just bring to everybody's attention a very important trap that a lot of people miss, which is if you are a US non-resident, so somebody sitting in India that owns some piece of US property, and that could be immovable property, it could be shares of a US corporation, Apple. If you pass away holding that US property, the US estate tax, you do not get the 15 million that you keep reading about. You get a exemption of $60,000. So anything over $60,000 is subject to an estate duty of somewhere around 40%. So that is a big trap that a lot of people are not aware of, that are US non-residents that own, US securities could face. So that is an important thing. Now, that was not impacted by this change in law. The change in law for US tax residents, people who are US, what we call US domiciliaries, the structure is like this. I can give during my life or upon my death, cumulatively $15 million of assets. So if I give 15 million while I'm alive, then I have zero upon my death. If I give zero while I'm alive, I have 15 upon my death. That 15 million was scheduled to, it had been increased and it was supposed to go back down to a much lower number at the end of this year. Now what the OB3 has done is it made this exemption permanent to 15 million per person. So a married couple, we get 30 million. But that's probably the biggest change. There was a lot of concern that those limits would go back down to a much lower number at the end of this year. But now we have this $15 million allowance for everybody to use. Again, that's if you are a US, let's call it a US tax resident.
So, so that deduction of 15 million on passing the estate to the next generation will include only US as asset or
No,
the worldwide asset?
worldwide assets.
And that is applicable to the person who is a US person at the time of death, right?
Correct.
That will also apply to the non-resident of US holding assets in US, passing on to the US persons.
Well, but then in that case, you're at the $60,000 limit.
That's all, $60,000. So
Yeah,
one has
so
to be careful.
huge difference between your status.
So one has to be careful in creating the US estate while you are non-resident,
Correct.
right?
So there's different structures that are, beyond the scope of what we can talk about today that people use to minimize and eliminate that estate tax duty if you're a non-resident, but that has to be done well in advance.
Understood. Understood. So slightly reverse question. If those US persons hold assets in India
Mhm.
and they want to bequeath or pass it on to the next generation who are the US persons, so those assets also will be included. That's we already clarified, right?
Yes, yes.
Yeah. And if any of the non-US assets are transferred to the non-US persons, is that law is still applicable?
Non-US assets transferred to non-US persons by whom? By a US person?
The US person hold assets in India. His
Yes.
relatives, next kith and kin are also in India. They are nothing to do with the US personality or US status. And they receive this on passing on their parents. And the parents are in US domiciliaries, right? Then whether those Indian assets will also be subjected to this deduction or subjected to taxes.
So, but I'm sorry, I misunderstood. In your example, is the US person receiving the assets upon the passing of the
No,
parents, or they own
passing to the next generation.
Yeah, so if they're a US tax resident, yes, it would be included in their worldwide estate.
All right, fantastic.
It doesn't matter if yes. And let me
Yes.
just add, in the question box, the person who asked this question asked about the limit is $15 million permanently. What does permanently mean? So in the US tax law, when they pass tax laws and tax cuts, there are they calculate how much money will the government lose, and usually they have to have an offsetting source of income. So in sometimes they can't accomplish that neutrality indefinitely. So they have to look at things on a limited window. So some provisions are built in the tax code to expire. So for example, we're not going to talk about it, but the tax on tips expires after a few years. So that's built into the tax code. Other provisions are just a permanent part of the tax code that Congress would have to change the law in order for those provisions to change. So the old estate tax exemption was temporary because the law itself said it was going to end in December 31st, 2025. The way this new exemption has been increased to 15 million is it is not expiring. Now, so by that's what we mean by as permanent. Of course, Congress could pass a law next year and change this. So nothing is really permanent, but there's no planned expiration of the 15 million.
Okay, so the next question from participant is that the non-resident has an exemption of US dollar 60,000 on estate passing to the next generation in the US.
Mhm.
So what is the tax rate in excess of US dollar 60,000 exemption?
It's approximately 40%.
Approximately 40%, more or less the similar taxes as levied on the US resident, right?
Well, yeah, the rate is the same. It's just the exemption is different.
Different, yeah. Okay, okay. So the next question, we go to the business questions. Prathamesh, this is a question on qualified small business stock.
Yes.
Yeah. So kindly explain what is this QSBS? What are the changes which we are finding in this new big beautiful act? And how would this affect or benefit the startup ventures or the investors from India? Yeah. Can you
Right.
kindly consider?
Yes. So the QSBS, the Qualified Small Business Stock, it's a very old concept in the US, and it's a beneficial for a lot of startup founders. Particularly, what happens is that when you have invested in a US company, by when a US individual invests in a US company, a US tax resident individual, at that point of time, the company, if the company size is smaller, the way the US defines smaller is that particularly if the gross assets of the company are less than $50 million, then it considers as a qualified small business. Now, particularly if a capital gain is earned from this qualified small business after a period of 5 years from the time the investor has invested in the US company, then a certain amount of the capital gain can be permanently exempted from a US taxation. Okay, that's the whole benefit of a QSBS. Now, how much amount can be exempted? So previously it used to be $10 million. Okay, there were other restrictions as well, but the annual exclusion limit was around $10 million on a qualified small business stock. So, which used to be a big benefit for the US founders on the startup, and especially you are looking for an exit after a 5 years period of time. Now, what used to happen, however, is that with this dynamic environment, okay, it's not necessary that you get a deal only after 5 years once you have been invested in the company. Now, you can get a deal within a shorter period of time as well, before 5 years as well. So, the US authorities took this into consideration, and it kind of made certain changes to this provision of QSBS. One provision that it made is that even if the US investor who is being invested in such companies for at least for a period of 3 years, okay, then also they will get a benefit of this qualified small business stock exemption. However, they won't get a benefit to the extent of 100% of their entire capital gain, but they will get this benefit only to the extent of 50% of whatever capital gain is earned from this qualified small businesses. If these individuals are invested for 4 years, then they get a benefit to the extent of 75% of the capital gains. And if they are invested for a period of 5 years or above, then as it is currently, they get a benefit of 100% against this QSBS sale. Also, the another change that it made is that it increased the exemption limit from a $10 million to $15 million. So that's also welcoming change for the US founders. And the third change that it made is with respect to the what's the definition of a qualified small business. So as I mentioned previously, it used to look at the gross assets, whether those are less than 50 million. Now that limit has been increased. So any company, US company whose gross assets are less than $75 million, that can be considered as a qualified small business stock. So broadly, these are the three changes that have been made under the QSBS purview.
All right. So this the gross assets must be fluctuating in the time of 5 years or 4 years or 3 years, right?
Correct. So it has to be looked immediately once the investments have been made. So thereafter, which that amounts can go up.
Okay. So even if it is above 75 million US dollar at the time of sale, you are not supposed to worry about it, right?
Correct.
You
Correct.
still get the exemption.
Yes. Yes.
Okay. And is there any conditions on what type of assets are considered or what type of assets are not considered? Is that something stipulation there on those assets?
Yes. So correct. So the only asset that is a qualified small business stock. So it has to be a share of a US company, a C corporation only. It cannot be a US partnership also, or even a USS corporation. It has to be specifically the USC corporation only. Also, it has restrictions with respect to the qualified businesses, in which
Yeah.
businesses the company can be, the C corporation can be invested in. Generally, the companies which are invested in are the which kind of run service businesses, and also those companies which are kind of being privately held or privately operated and managed. Those generally do not qualify for the QSBS. But apart from that, all other companies generally qualify for the QSBS benefits.
Okay, so there are restrictions if companies are a service company, right? That's what we
Okay,
understand.
so not all service companies, they have given a list of various companies which includes health, law, I think even something on IT consulting as well. So they have a huge list of exclusions that they've provided. What does not qualify for QSBS? Apart from that, everything else qualifies for QSBS.
And is there any limit as to what are the, some exemption on if the entire asset is not used for the business, some of the assets are used for the business. Is there any limit? I mean, something like safe harbor, that if 90% of the assets are available, then it is deemed to have been utilized for the purpose of business. Is there some sort of a safe harbor is given for that?
I'll have to check, but I think it's about using the entire. It has to be
Or
justified that you are a qualified business, that you are running an active trader business. Having just a passive business, that does not qualifies you for a QSBS.
why I'm asking this question is, let's say you are, it's a startup ventures, you are, issuing series after series for the purpose of investment, and they are eager to close the rounds when the investors are, willing to invest. Probably all the assets, all the funds may not have been utilized for the purpose of the active business, but part of the fund may have been, invested for the temporary period into the treasury or some sort of investment instruments. So whether such thing is something permissible or not permissible? That's what my question was.
Right. I think if it has a valid business purpose and so on, I think that should be permissible. Particularly given the fact pattern, that we receive the funds, the utilization, we know that it is going to happen down the line. Okay, while not immediate, it's going to happen down the line. That should be permissible, but I can check in much more detail later.
All right.
And I'll just add, there are some mathematical safe harbors about idle cash, because what you've described, Paresh, is a very common situation. So there is some aspects of the statute that address this.
Okay. Thank you so much. Next question from the participant is, for a non-resident of India who is resident of US, whether dividend income from Indian company would be subject to tax in US, or there will be some participation exemption available. If such dividend income is taxable, and what is the rate of tax in the United States? I think it's a question both both of the panelists can answer probably. You want to pick up,
Yeah.
Naveen?
Yeah, I'll take it. So if I'm a US tax resident and I receive a dividend from an Indian company, so in the US we have two basic tax rates on dividends. One is just ordinary, based on your ordinary slab. But most dividends are something called a qualified dividend. And to the extent that it's a qualified dividend, the maximum federal rate is 20%. If your income is above, it's either 200 or 250, there is a net investment income tax of 3.8. So 23.8. And then your regular state tax, most states do not have a special tax rate for dividends. So 23.8 is probably going to be your maximum federal tax plus states.
So if there is a withholding tax from India, the balance tax will be payable in the United States. That's what the answer is.
Correct. I mean, well, yes. I mean, you still have to go through the foreign tax credit calculations. That's a separate matter, but the maximum US rate will be the 23.8. And generally, you're not going to get a foreign tax credit against your net investment income tax. So best case, you're going to be paying 3.8%.
Thank you so much. This brings us to a question from the participant on contribution to the charities. The question is, what are the deduction available either in India or in USA? Comparing the deduction available in the two countries, whether there is an arbitrage possible by setting up the charitable trust in United States and contributing to such a trust from several business concerns either in USA or from India, in order to get that arbitrage benefit. If one of the charitable trusts, whether it is formed in USA or in India, and contributing to such a trust will give some benefit in terms of deduction. As I understand that the deduction in India is limited to the qualifying income. So the question is whether it is advisable to form a charitable trust in United States and contribute to such charities from India.
So
Prathamesh?
I'll give my thoughts. Oh, go ahead.
Yes, see, so from a company perspective, particularly if when a US corporation makes a charitable contribution, it can claim a deduction for it and against its US taxable income. Okay, but there are two conditions to it. One, it has to be a qualified donation. So only those entities which are kind of registered within the US as a charitable organization, contributions only to those organizations can be deductible for US tax purposes for the US corporate law perspective. Also, there's another limitation that any charitable contribution can be deducted only to the extent of 10% of taxable income. So even if the significant contributions are made, it generally is restricted to the extent only to the extent of 10% of taxable income. The unutilized deductions can definitely be carried forward, but it can again be carried forward only for a period of 5 years. Thereafter, which it kind of lapses. So overall, the timing also needs to be considered. Overall, the taxable base also needs to be kept in mind. Especially if it's a loss-making entity within the US, they may not be able to get that benefit itself of a charitable contributions in a near future.
So, so what is your take? Like whether the setting up a charitable trust in US is preferred over the Indian trust and spend a contribution to the US trust rather than the Indian trust?
Right. See, so if you kind of have a profitable position in the US, then making contributions in the US can give you a good tax benefit perspective. But as I mentioned, if you have a loss-making situation, then
Okay.
making those charitable contributions may not give you a tax break that is needed.
Yeah, I think that makes sense. Yes. Now let's see whether there is any. This is a question from Manish Agarwal. What about DRD deduction? I didn't understand what is DRD deduction.
So I think what he was saying was when we were talking about the foreign tax credits, um, I think he was referring to that. So when I was talking about the taxation of foreign dividends, sorry, I was talking about it from the perspective of an individual. If I'm a US corporation and I get a dividend from a foreign corporation, I may be entitled to what we call a dividends received deduction based on, it's probably too complicated to get into here, but it's really an interaction of the GILTI regime as to whether I will not have to pay tax on that dividend again.
Oh, okay. So yeah, if you're already taxed on and the entire income, then that dividend is paid out of that income only. So why to tax why there is a double taxation? That's what you want to say?
That's the conceptual underpinnings behind GILTI or what's now called net tested income.
Okay, so those items will be deducted for the so those items will be deducted for the purpose of guilty, or those items will be separately taxed on a net level basis in USA.
Well, the concept is that if I'm recognizing US income under the GILTI regime, um, whether I pay tax or not, the subsequent receipt, transmission of a cash dividend does not create an additional layer of tax.
Yeah. Now the question, therefore, the if you have only dividend income, it will be taxed at a higher rate in United States, right? But in the under the guilty regime, the tax rate is little lower, right? 10.5,
Mhm.
18.1, 90% of the
So
overall 20% rate. So, Prathamesh, would you like to throw some light on this?
correct. See, so the guilty regime is the laws are kind of different for individuals and the laws are different for the corporations. Okay.
Okay.
So for corporations, as discussed for guilty, the tax rate is effectively it's 21%, but based on the 250 deduction, it effectively comes down to 10.5%. Okay, and for the US corporates, whenever the dividend income is received, okay, from the US corporates, from the Indian corporation to the US corporation, that dividend income is generally exempted for US tax purposes under the section 245E, which is a dividend received deduction, the participation exemption. So even so what we discussed about the high tax exemption, So even let's say the US corporation did not include a guilty inclusion at all due to the high tax exception available for the higher effective tax rate paid in India. Then also, even there, while there is no guilty inclusion in the US, but let's say in future if the same amount is distributed as a dividend from Indian corporation to the US corporation, then also still it will be exempt for US tax purposes under this 245A dividend received deduction, purview. So that's a concept for the US corporations. However, for individual, Mr. Vinay will definitely add on it. But for individual, I think this participation exemption is not available. However, what happens is that if something is already taxed in the US through the guilty regime for the Indian individual, that amount cannot be taxed again in the US because it's already been subject to tax. Hence, when the same amount is kind of distributed back to the US individual, at that point of time, it's generally known as a previously taxed earnings and profits. Because it has been previously taxed in the US, again the dividend is not subject to tax in the US, and the guilty rate for the individual can be higher. Even the individual is not available, that 250 deduction, the 50% deduction which I refer to, is generally not available in case of the individual. There are other mechanisms with respect to 962 election and so, but generally speaking it's generally not available to the individuals, and that's why the rate of guilt is generally higher for the individuals.
Okay, understood. Understood. So do you want to say that the guilty tax is higher in the hands of individuals as compared to the corporates, right, Prathamesh?
Yes, yes. So there is a code section 962, which kind of can create an interposing domestic corporation, but that will become too complicated. It's a whole different topic. Uh, but there are some mechanisms, around that as well that are available.
So, okay, I understand because the corporation being a shareholder, US corporation being a shareholder, again on distribution they'll be subject to dividend tax, isn't it? Isn't it?
So, sorry, can you repeat it?
The US corporation, which is a shareholder in the US, which is shareholder in the Indian company or a LLP, which is subject matter of guilty taxation, and which is subject matter of receipt of dividend from the Indian company or LLP, then the US corporation, while making payment to dividend to the US shareholder, which always be subject to dividend tax, isn't it, in US?
Correct, correct. That
Therefore,
that
I think the taxation in the hands of the individual shareholder versus the corporation shareholder being concessional is well justified, right?
correct,
That's
correct.
the
So yes, but ultimately it needs to depend, where we need that money. Whether we need to park that money in the US corporation level itself, or you need to have that money at the US individual hands. Whether you need to, pay that taxes at this moment itself, or you need it in the corporation. So you better wait. So,
understood.
yeah.
Understood. I think it's well explained logically also and properly also. Now we come to the lot of questions from participants, so we'll stop my questions.
Yes, there's a lot of questions I see.
Yeah, yeah. The resident of USA having immovable property in India want to sell this particular property in India. Taxes are payable in India as capital gains. Very interesting question. Is this tax to be disclosed in the USA? What will be taxes payable in United States? Or whether such tax credit will be available, which are paid on capital gains tax of immovable property in India? Very interesting question. Yes, Ganpat Raj has raised this question. Can Naveen, you want to answer this?
Sure. So this is a very common question. I feel like I get this question almost every day.
Yeah.
We have to pretend as if that same piece of property in India was in the US. And what would the gain calculation be in the US? And what frequently happens here is the person who's selling the property did not buy the property. They received it either as an inheritance from their parents who passed away or as a gift while their parents were alive, or in some cases they purchased it. But depending on which one of those three avenues they acquired the land, that will determine their cost basis for US tax purposes. We know what the selling price is, so then we have a gain. That gain is offered to tax on the US tax return. It doesn't matter the fact that the property is outside of the US. And then we go through a separate calculation of the foreign tax credit calculation as it relates to gains. And we generally will not get a dollar for dollar tax credit. Usually it's a reduced credit. It's a very complex calculation, but that will be the net impact of of the US tax liability. In addition, that resident of the USA, if they live in a state that has an income tax, will have to offer that same gain to state taxes. And most states do not offer a foreign tax credit for taxes paid to another country. So they're often very surprised to see that they have to pay another level of tax, even if they were to get a full credit for taxes paid to India, which they generally do not.
Now, the follow-through question,
Mhm.
the answer is same for shares of the company situated in India.
So that's actually a very good question. The calculation of the gain is the same. And I would love to get Prathamesh thoughts on this, but there is a open question as to whether if I'm in the US and I sell shares of an Indian company, and I have tax, I pay capital gains tax in India, whether that's even allowed at all for a US tax credit. It gets into some very specific rules about how the US sources capital gains, and it gets to some very cloudy language in the US-India tax treaty. So I would say my personal belief is that you do not get a credit, but I know there are people out there who believe that you do.
Thank you. I think that's the understanding which most of the tax practitioners have in India. What you said. It's a source to source conflict. Both
Yes.
countries consider this as a source of income in their own countries. Therefore, credit of capital gains tax on shares are not available. That's what probably. Prathamesh, is your understanding also?
Yes, yes. So it's unfortunate that particularly the US is kind of sourcing capital gains based on the residency of the taxpayer,
Right.
and India is kind of sourcing based on the situs of the company. Unfortunately, the India-US tax treaty, it also kind of did not provided any leeway to it. It simply mentioned that both countries continue to have the right to tax based on
This
their own domestic laws.
law will
So
apply.
that's why it's a big conflict. The only exception that is available when there are the US shareholder, be it a US corporation or be it a US individual, owns more than 80% in an Indian corporation. Then in the US, the foreign tax credit can be available. Uh, Apart from that, currently there does not see any escape.
Okay. So you will need a special structuring to probably avoid one of the taxes without tax credit. Right?
Correct, correct. So that's why even at the time of formation itself, it's important to analyze the capital gains that can arise in the future.
Perfect. Perfect. Now we one more follow-up question. Sorry about this, Naveen. That as you mentioned about the gift or inheritance of the immovable or the shares will not park on the side, but on immovable properties, it is inherited by the US resident. The property is located in India. In India, the computation of capital gain assumes the cost to the previous owner and the cost to the bequeathee, right? So, and the assets are considered as long term based on the period of holding being held by the previous owner who is deceased. Whether similar provisions are there in the USA or you ignore because the holder has not contributed to anything on the cost. So how do you compute such a capital gain in
Yeah.
United States?
So it's actually very different. In the US, we have a very big distinction on how you acquire the property. If you acquire the property as a gift while the donor is alive, then your cost basis becomes the donor's cost basis. So if your parents bought the property and paid a very low value and they give it to you while you're alive and you sell it, your cost is that very low cost that they paid. If, on the other hand, you only acquire it as a result of their passing, so in their will, it says that upon my death, I give my son or daughter this piece of property. Then for US tax purposes, we have what we call a step up. And we look at the fair value, the fair market value on the date the person died, and that becomes the cost basis. So in theory, parents could own property, highly appreciated, very low cost basis. They leave it in their will to their child. Child sells it the next day and pays zero gain in the US. So very
Oh,
big difference in how you acquire the property.
no, thank you so much for this because it's computed differently in United States as compared to in India. That helps everyone here. Yeah.
Mhm.
Now the next question from the participant is: will U.S. resident beneficiary be entitled to tax credit of taxes paid by trust in India in respect of the income distributed in the year in which it is earned? The question is: there is a Indian trust. The US resident is a beneficiary in the trust. On the trust income, the taxes are paid in India, and the income is also distributed in the same year to the US beneficiary. How this income will be taxed in the United States, whether the tax credit will be available or not? That's a question.
So I will tell you, I do not know. And the reason is, not the reason, but the US tax rules that apply to foreign trusts with US beneficiaries are it's a very specialized and complex area. And if you have that situation, you need to make sure that you're dealing with a US person who really knows those rules well. They're known as the throwback rules. And I have a guess as to what the answer is, but I'm not going to tell you my guess because it's just a guess. It's just important to get specialized advice if you're dealing with US Indian trust with US beneficiaries.
Yes, because Indian trusts, whether discretionary or non-discretionary, they are taxed on a current basis as the income is earned, irrespective of the distribution. Here, the participants have raised a simple question as to that the income is also earned and distributed in the same year. There could be a complication if not distributed in the same year and distributed this little later. But here the question was pretty simple that it is taxed in India in the year in which income is earned by the trust, and in the same year it is distributed. But yes, we take your advice and consider that it requires a special advice, and probably that's a answer to the questioner. Yeah, thank you, thank you. Yeah, and I also understand that the concept of the US persons controlled foreign trusts and other things do take place in this scenario when you have to tax such trust in United States. Yeah, and the fact is also silent whether the US person is on the board of trustees on the Indian trust or not, etc. So I think it's a complex trust regime taxation in United States. So need to take a better advice, and it probably cannot be answered on a standalone basis. I agree with you. Thank you so much. The next question is and follow up on the immole property, that there is an affirmation that yes, because of this computation of the capital gains in United States, there is no availability of indexation in USA. And the question is, can we use home exclusion for Indian home? Home exclusion for Indian home while computing the capital gains in United States, as we have in India. No, I think that's a question.
Okay. So I'm going to guess at what the question is, because in the US, we have this ability to exclude on a joint return up to $500,000 of gain if you sell your principal residence. So I believe that if I'm a US citizen living in India and I sell my principal residence, the home that I'm really living in, then there's a test. You have to be living and using it as your home for 2 out of the last 5 years. I believe that still qualifies. I don't think the primary home has to be in the US for that provision to apply. But it's got to be there's a very specific criteria as to your use of the home. So if that's what the question is about, then I think the primary home exclusion could work.
So so the answer is based on the fact whether it was made available for the use as a home, then only you get the deduction.
Well, whether it was actually used as the home, right? So
Okay.
I can see this applying to a US citizen living in India. And selling their home and buying a new home, that up to 500,000 of gain would not be subject to US tax. I'm not sure if that's what the person has meant in their question, but
Yes, thank you. This was a question from anonymous attendee. Now the next
yes.
question is from keep reporting in US is believe and parent remit for kids in USA. Yes, the question is from Abhinav Gulecha. Indian citizen living in US returns in a mid-year to India for permanent settlement. Does he need to file a dual status aligned return for the year in US, or can he file a regular 1040? Basically, whether there's a concept of split residency or not, that's a question probably. Yeah, Abhinav Gulecha. Can you take up, Naveen?
Yeah, sure. So the general answer is yes, it would be a dual status return. If you were in the US at the beginning of the year, either on a green card or employment visa, whatever. Well, the green card is a bad example. But if you were in the US on some sort of visa, and you had been in the US so that you had previously been a US tax resident, and then you leave the US on August 1st and you don't come back to the US, then yes, you would be filing a dual status return and would not file a regular 1040 for that year.
Okay, so you said that a normal US resident, other than the green card holder and the citizen.
Of course,
So
yes.
will the answer be different for the green card holder?
Yes, well, you get now into an intersection of tax law and immigration law, because as a green card holder, you're not supposed to be living outside the US. So there's a question as to whether you still have a valid green card. And if you have a green card and you give it up, and you've held the green card for 8 years or more than 8 years, you have an exit tax. So this is a very tricky situation if somebody either affirmatively gives up their green card or abandons their green card by moving back, by moving out of the US, as to whether you may have triggered that exit tax.
No, my question was from the different background. The question
okay.
was that yes, we understand US citizens are taxed on a worldwide basis, no matter whether they're resident or non-resident.
Right.
The Indian Indian citizen who is returning to India, half year answer is given, and we have all understood the question. But in case of a green card holder, the person is not required to stay there. He can still be a resident of India. So the answer will be different. That's what my question is.
Well,
Green card
maybe I'm
holder,
misunderstanding.
but resident
Yes.
of India.
Yeah. So okay. So let's assume that the green card remains valid.
Green card
Okay.
remains valid.
If the green card remains valid for US immigration purposes, then it's as if you're a citizen. You're taxed on your worldwide income. So there would be no dual status return. You would file a regular 1040 for the year.
And if a person who is an Indian resident would like to access the tiebreaker test of India-US tax treaty, and if is treated as an Indian resident for the purpose of tax treaty, would the answer be same or will it be different?
So it would be different, but if you are a green card holder and you tie break to India, that is generally considered at least for tax purposes, giving up your green card. So you have to watch out to make sure you're not going to trigger the exit tax by doing that. And that can have legal implications on your green card. So I would not do that very lightly. Clients who are going to do that to tie break to India who have a green card definitely need to have their U.S. immigration attorney as part of that discussion to make sure they're not causing bigger issues.
Yeah, question was purely from technical perspective that
Yeah.
your residency status is purely for the purpose of India-US double tax avoidance tax treaty and not for any other purposes.
So
and that will vary from year to year.
Yeah. So if you successfully tie broke to India, then you would file a dual status return. But again, I think it's there's a lot of landmines with that. You have to be.
No, I understand. I fully. I'm raising this question only for the
yes.
Your experience being available to all the participants, and there's a complex area of the linkage between immigration status and the tax residency status. Yeah, because all of taxpayer understand. Yes, citizen of America, worldwide tax. There's no question of any tiebreaker test and etc. But for green card holder, we can always explore. That's why the question was. Yeah. And then Indian source income not liable to tax anywhere in the world, including US. That's the philosophy and the background in which this question was raised to you, Naveen. I think you aptly answered this question. Thank you very much. Yeah. So let's go to the next question. There is a question from Ganpat Raj. US citizen stays in India for more than 180 days and is getting salary from US company working in India at home. So it's a work from home concept, and he's working from India, 180 days stay in India. Pays taxes in US normally because US corporation will always apply W2 and deduct the taxes. US citizen also has rental income in India and later want to sell the immoral property. Since she stays more than 182 days in India, the world income is taxable in India. She is a US citizen staying in India for more than 182 days, and therefore she is liable to taxation on a worldwide basis. She claims tax credit in India for US taxes paid on salary, files tax return in India, pays tax in India as US dollar salary converted to Indian rupees, and pay taxes in India. Can the person claim tax credit for taxes paid in India on salary, income, and rental income in India while filing probably tax return in US? See, this question is not properly structured, I believe. So let me just reframe this question. She is a US citizen, therefore liable to taxation on a worldwide base in the USA. She has now become resident in India because of 182 days stays in India. We are not regarding any citizenship status of US as a criteria under the Indian tax law, and therefore she becomes liable to taxation in India on a worldwide basis. Now the taxes are deducted in the US while paying a payment of salaries to her. Now she will file. So my question is, what is the guidance to such a taxpayer who is liable to taxation in India by virtue of being resident in India, stay in India, and by virtue of citizenship in United States? So how would you guide such a person who has a salary income from US and rental income in India?
So if they're a US citizen, our starting point is that all the worldwide income falls on the US tax return. And as a US citizen, they're entitled to a foreign tax credit for taxes paid to other countries based on our foreign tax credit rules. For services, we look to see where the services are performed. So if she's doing work in India, then the service income would be foreign sourced. And if the rental income is from real immovable property in India, then the rental income is foreign sourced. So you would go through the respective calculations and claim the maximum foreign tax credit you could on the US tax return for taxes paid to India. That would be my approach.
So now, since she is being taxed in India on a worldwide basis, she will have to file tax return in India also. And probably probably she will not get any tax credit on the taxes paid on salaries in the United States because under the domestic tax law of India, such salary is earned in India because performed in India. And also under India-US tax treaty, since she is staying in India for more than 183 days, the right to tax is in favor of India under the India-US double tax avoidance tax treaty. Therefore, she will not get a tax credit of any US taxes paid because source of taxation of salary is in India. Is that something complication will arise, or there is a better solution to this?
Well, from a US tax point of view, I think the US side is pretty clear. Taxation on worldwide income and foreign tax credit on foreign sourced income. So the double taxation is being mitigated by the US giving a credit for taxes paid to India. I understand the Indian position that you will not get a foreign tax credit for taxes paid to the US. So you're still paying, in theory, one level of tax, right?
And now,
India, US, and US is giving you a credit for India. Now it won't work out, dollar for dollar that way, but conceptually it works.
okay, so while giving tax credit in the United States, will the United States be treating this salary tax paid in India as a source tax? Because source is not in India according to the US law.
No, if this person's working in India, if they're physically performing the services as an employee in India, then it's foreign sourced.
Okay, okay. So the Indian taxes paid will be available in the United States as a taxes creditable against the US taxes. I think
Yes,
the
in
job
this
is
example,
that
yes.
should be no problem. Yeah. Thank you so much for this answer, which was really complicated. You made life very simple. Prathamesh, you have any supplement, please? Feel free.
No, sure, sure. No, nothing on this point, Paresh.
Thank you so much. Yeah. The next question is, US citizens come to India to retire. Some of the investments are brought to India. Are there any restriction on them for investing in Indian stocks and Indian mutual funds? Will new beautiful bill will have any change in this taxation? US citizens come to India for permanently, for good. And some of these investments are brought back to India, means they must be disinvested. Are there any restriction on them for investing in Indian stocks and mutual fund? Will there be any impact due to this, the new bill? That's a question from Rajesh Vajay.
So I think the short answer is that the OB3 really does not change the outcome of this question. The same rule that same concepts that existed before continue to exist. Generally, I think many of you know that the US puts Indian mutual funds in a category known as passive foreign investment companies, or PFICs, which create quite an amount of complexity and generally a higher rate of taxation. So my advice to clients is to try to avoid Indian mutual funds wherever you can. I would much rather than invest in a portfolio of Indian equities directly. So that's the short answer.
Yes,
if they wanted to invest in Indian mutual fund, they certainly could. But I would tell you from a US tax point of view, it's not advisable.
I agree. Yes, probably due to market requirement on every accounting year and the complexities if you don't do that mark to market, right? That's
Correct.
the reason. Okay.
Correct.
Thank you so much.
Correct.
So, is there any? Of course, this is my question following from Rajesh Vajay's question. If the US citizen is permanently coming for good to India, I understand that the law travels with the US citizen into India and he's supposed to file the worldwide tax returns. So your advice is that avoid anything which creates complication in filing the US tax returns.
Mm-hmm.
So is there any, when this person comes for good to India, is there that mechanism of exit tax applies to him?
As long as they retain their US citizenship, no.
No
Only if they
question.
give up their US
Only
citizenship, then they
surrender
become
of
taxable.
citizenship, and I think similar consequences arise on surrender of green card also, right?
If you've had it more for 8 years.
More than 8 years.
8 years.
Okay, thank you. And also for normal US residents,
You mean visa holders?
visa holder, yes.
Yeah, visa holders don't have exit tax.
Fantastic. I think that completes the answer on Rajesh and follow-up questions for in my mind. Yeah. Next question is from Jankana. Can you explain the concept of effectively connected income in United States? And the further follow-up question from her is it similar to poem or permanent establishment? Whether Indian individuals earning professional fees from a US company is effectively connected income in United States and liable to file tax return in United States? That's a question.
Prathamesh,
What
do
is
you
the
want to take this
concept
one
of?
since it's more business related?
Sure, sure, I
Yeah,
can take this question.
I think so. I think Prathamesh can answer this. Yes.
Yes, yes. So the US effectively connected income, basically the concept what it is about, your whether you are having an active trade or business within the US or not. It is more linked. It's not similar to the poem, but it's more kind of linked towards the permanent establishment concept. Okay, just because you are getting a services from a US customer, you're providing all your professional services from India, and just because your customer is from the USA, that doesn't mean that you create or you have a ECI income, the US effectively connected income. Even in such situations, you may not be considered to have a US ECI income because you do not have any presence in the US. Okay, either you when can you have a presence in the US? When you have an employee who is there in the US, you have a real property within the US, you have some an independent agent who is exclusively working for you full time from the US. Then are the situations where you can consider to have a presence in the US and eventually effectively connected income within the US. But by mere provision of a services setting from India completely to a US client does not necessarily lead to a US effectively connected income. That means hence it may not be taxable in the US at all. It needs to be evaluated whether the withholding tax needs to happen from the US or not by the US customer. But generally, in such situations where it's a pure services that are getting provided, and there is no kind of a technical know-how or that is getting passed also, in such situations, US effectively connected income may not arise and may not lead to any tax exposure in the US.
Probably it is a concept similar to business connection in India,
Correct, correct.
but not a permanent establishment.
Yes, yes.
And in India, sometimes business connection is considered as permanent establishment in certain situation as defined in Section 9 of the Income Tax Act, I believe. Yeah, that's the answer, Jankana.
Yeah.
The next question is from Parth Narayan. Social security payments received by Indian resident taxpayer. Social security payments received by Indian resident taxpayer. Is there any tax credit available? Withdrawal from social security basically received by the Indian resident taxpayer. Is there any tax credit available on such social security payments? Of course, provided these social security payments are taxable in India. So you can
So
answer probably, Naveen, whether such social security payments are taxable in India or not. Of course, it's not a US tax law question, but
so
I
this is
would like
assuming a
to,
US citizen moves to India and is collecting US Social Security, correct?
yeah.
So I would not expect, so under US domestic law, there would be no tax credit available because it's US sourced income. I don't know if the treaty changes anything there. I would not expect it to. So my guess is that there would be no credit available. It's simply subject to tax in the US.
The question is, can non-US resident file joint returns? What happens to the H-1B holder, now Indian resident and citizen, whether he has to file US tax return for 401k gains or withdrawals? He has a SSN which has taken when he was on H-1B visa. So can non-US residents file joint returns?
General answer is no. If you have one spouse who's a US tax resident and another is not, there can be an election made to treat the non-resident spouse as a resident for US tax purposes. But then that spouse who's making the spouse who is becoming a US tax resident is now offering their worldwide income to US tax for the ability to make a joint return.
Whether next question is on buyback of shares, probably to Prathamesh. Whether buyback tax paid by Indian corporation on I think this is a hypothetical question because India doesn't have now buyback tax, is treated as a dividend. But maybe in the old regime, in India, levied the buyback taxes and paid by the companies. So in that respect, whether the buyback tax paid by Indian corporation on distribution to US resident before 2024, because the law changed in 2024 in India, whether tax credit of the buyback tax paid by the corporation is available to the US resident. That's question to Prathamesh.
Right. See, so over there also you have to look more from a sourcing rules perspective first of all. Uh, Particularly as we discussed, the sourcing rules itself is a challenge to claim a claim.
Challenge. Yeah. So I think answer is same on capital gains on shares, which we
Correct.
have already debated. Yeah, perfect. I think that completes all the questions from the participants. I think we have done wonderful job. But panelists has done wonderful job. They answer all the questions of participants. Yeah. And then we can keep the floor open if you want. Prathamesh or Naveen, you want to highlight any of your experience as to how to deal the situation between India and US, particularly when you are liable to taxation in both the countries.
Right.
Anything you want to highlight to the participants? Yeah, because we have a few minutes left so that we can give a full justice of 2 hours to everyone. Yeah,
Yes. So I'll go first. Particularly
yeah,
one also
please.
important provision which we didn't talk about, which was introduced as part of this one big beautiful bill act, mainly for the U.S. corporates. It's on that 100% bonus depreciation. So now what has happened is that this 100% bonus depreciation, was there in the US law, but it was now kind of getting sunset. Okay, so wherein within the next 2 years it will have come down to zero. Okay. Uh, However, now this has been reinstated, particularly whenever the US companies make investments in a capex, in a tangible fixed assets, then those US companies are allowed to claim 100% bonus depreciation in the first year itself. Okay, while we name it as a bonus depreciation, it's not that it's over and above its cost basis, but the entire cost basis, what it means is that can be depreciated in the first year itself. So it's actually a good thing for those companies or those individuals who are looking to start up a US business or so, and looking towards a substantial capex in the US. They can actually claim a good benefit out of this provision. So this is one thing to keep in mind.
Yeah, yes, that is, I think you're talking about US Section 179 of the US RIs.
It's yeah. So there are two sections, Section 179 and Section 168K, but both eventually lead to the same thing. 168K has a much larger scope in terms of the amounts involved. 179 is generally for a smaller portion of the amounts invested if the investments are small. So,
Thank, thank you so much. Yes, I think both the panelists have ably answered all the questions, and I'm very happy and thankful to both of them. And over to Mahesh and Rutvik.
Thank you, Paresh bhai. I think, and thank you to Vinay and Prathamesh. I think for a fantastic, exposition. I think a wide, range of topics, have been covered. And on that note, may I request Jagat Mehta to kindly, propose a very well deserved vote of thanks to the panelists today.
Yeah. Thank you, Mahesh. Friends, you would agree that this new bill has created lots of interest not only in US but across the globe. India being no exception to it. Today's session, a fireside chat where many questions were from the practical perspective, including and the participants raised different questions which they are facing it. Excuse me. We have a really very well panelist in the form of Vinay, Shri Vinay Navani and Shri Prathamesh Hegishte. We also participant on behalf of BCS and the participant. We would like to thank both the panelists for providing their insights into this new bill. Last but not the least, we would also like to thank Paresh Bhai for chipping it at the very last moment. Like in few hours time, he agreed to moderate the session, and he really wonderfully moderated today's session. Thank you, Paresh Bhai. Thank you, everyone, for such an enriching session.